Welcome to another Taking Stock episode for the week ending the 17th of July, 2026. I'm Trinh, Head of Research at Stock Doctor. And joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome aboard, Matt. Great to have you on board today.
It's my pleasure, Ken. Good to be joining you.
Yes, and just before we begin, a reminder that today's discussion is general in nature and won't consider your personal situation or needs. But Matt, markets were a little more constructive this week after softer US inflation data, and that supported expectations that interest rates may remain on hold. But here in Australia, though, we've seen quite weak household spending, and consumers are becoming increasingly selective with their spending habits.
Yeah, I think that's right, Ken. And Commonwealth Bank's latest household spending data suggests that consumers are becoming more cautious with softer spending across retail, hospitality, and recreation, despite the usual end of financial year sales. As we head into reporting season, the key question is whether companies can still deliver earnings growth in what's clearly becoming a more challenging environment for the consumer.
Yeah, definitely. And we've seen a few more kind of downgrades occur this week. But just speaking about some star stock highlights, I think we've been in that quarterly mining update season. And let's start with BHP and Rio. They delivered solid operational updates, but the biggest takeaway wasn't iron ore. It was really copper, wasn't it?
Yeah, while both miners did deliver broadly solid operational updates, the real focus was on copper. BHP's outlook disappointed slightly with FY27 production guidance impacted by lower grades out of Escondida and temporary operational disruptions. Meanwhile, reinforced confidence by maintaining production guidance and delivering further cost improvements, highlighting the strength of its operating performance.
Yeah, and obviously they will move with the underlying commodity prices, but the key takeaway really is that copper remains their primary long-term growth opportunity as the investment into electrification, AI infrastructure, and electricity networks continues to accelerate. But on the resources front, Matt, a stock under pressure this week was copper miner AIC Mines or A1M, and despite meeting production guidance for the third consecutive year, they were sold down quite heavily.
I think the market focused on a weaker June quarter, with higher diesel costs, lower ore grades, and wet weather really driving production costs a lot higher. We see these as largely temporary headwinds, however. And in addition to that, concentrate shipments that were delayed at quarter end are expected to be recognised in the September quarter, providing a boost to sales in the next quarter.
Yeah, I think investors were just finding a reason to take some profits off the table there. But more importantly, it was that Eloise expansion and also Jericho development. They remain on schedule, and that should underpin management's plan to lift their annual copper production from around 13,000 tons to around 20,000 tons over the next few years. So growth is certainly on the cards there. But during the week, we also removed Nick Scali from our Star Growth stock list. What's the rationale here?
Well, as mentioned earlier, our main concern is the housing backdrop. Following changes to negative gearing and capital gains tax, housing turnover is expected to remain subdued. And management has previously flagged that trading does soften when housing turnover is weak. So we think the earnings risk has increased heading into the reporting period. And this is reflected in the negative earnings revisions for Nick Scali over the last 3 months.
Yeah, that outlook doesn't look too great, does it, Matt? But finally, let's touch on Objective Corporation. That's government software business. Now, we've decided to retain the stock as a Star Growth stock following further discussions with management.
I think the initial reaction was driven by concerns that Objective had lost the defence customer altogether. But after speaking with management, we don't believe that is exactly the case. Defence continues to use the software, but it chose not to renew its annual support agreement, which management attributes largely to budget constraints following a price increase. Now, while the lost support in revenue is a headwind and it represents about 7% of its recurring revenue base, we do believe that the market's initial reaction has overstated the long-term implications for the business, which is why we've retained the stock as a Star Growth stock.
Yeah, those earnings revisions look quite severe there, Matt. But importantly, though, Defence has used Objective software for decade. So replacing it would be more complex and costly and time consuming for defense. So there is a good chance that they will need to come back to the table to negotiate. Now for Under the Microscope. This week we're taking a look at Elsight, and the code is ELS, and it's an emerging Australian technology company that's benefiting from the growing adoption of drones and autonomous systems. So Matt, for investors unfamiliar with the business, what exactly does Elsight do?
Yeah, well, Elsight has developed a communications platform called Halo, and that keeps drones connected by intelligently combining multiple communication networks, including cellular, satellite, and radio, all at the same time. And that level of reliability is critical for applications such as defense, emergency services, and industrial inspections, where losing connectivity simply isn't an option.
Yeah, certainly a strong thematic there, especially with the increasing Middle Eastern crisis overseas and also the increasing spending in defense worldwide. But founder-led businesses have often produced strong long-term outcomes for investors in the early stage of growth. So is that still the case here?
Yeah, I think so. Founder and CEO Yoav Amitai remain. I don't know whether I'm pronouncing that correctly, but he remains very closely involved, which gives us confidence that the business continues to execute on its long-term strategy. And importantly, the investment story is now being supported by improving fundamentals with strong cash generation and a healthier balance sheet, lifting Elsight into a strong financial health position.
Yeah, it's had one strong period of financial health there, Matt. But analysts are also forecasting very strong revenue and earnings growth over the next year. And how much confidence should we expect from these numbers?
Well, as you know, Ken, it's important not to rely solely on consensus forecasts when there are only two analysts covering the stock. But what gives us greater confidence is the operational momentum that we are currently seeing. The company recently secured a $2 million follow-on order from an existing US public safety customer, more than four times the size of the original order. And combining that with a record 11.6 million first quarter, a US 12 million contracted backlog, and a US 156 million sales pipeline, we think the current growth expectations are very well supported.
Yeah, certainly very strong kind of pipelines there, Matt. But investors should still recognize that defense contracts can be quite lumpy. But the stock is also trading at around 23% below their consensus fair value, although it's still on a forward PE of roughly around 50 times. Is that expensive?
Probably not for a growth stock with that much work under its belt, but there is a trade-off, obviously. Traditional valuation metrics become less useful for businesses expected to compound earnings at double-digit rates over many years. So while Elsight is trading on a 50 times forward earnings today, that multiple could fall quite quickly over time.
Yeah, definitely, Matt, and certainly a stock to put on your watch list this reporting season, and it could potentially come into our star stock portfolios once it releases its first half results in late August. And now it's time for question of the week. And with reporting season just around the corner, many investors would be wondering how they should manage their portfolio risk over the next few weeks.
And I think the first and obvious place to start is with diversification. You need to make sure you're diversified not only across individual stocks, but also across sectors and asset classes. That way, one disappointing result or an industry downgrade, for example, won't have this outsized impact on your own portfolio.
Yeah, definitely worth it, especially during reporting season where stocks can be very volatile. But secondly, you should also monitor your earnings revisions. They are often one of the best indicators of changing operating conditions for that company. And we generally have greater conviction in those businesses that have recently reaffirmed their guidance or provided positive trading updates leading into their results. So that creates a lot less uncertainty heading into that result.
Yeah, it can. And my advice is also to keep some cash on the sidelines. If a stock has rallied really strongly into a reporting period, that oftentimes does tell us that expectations are often very high and it is a somewhat crowded trade. So it makes sense to take some profits into the result, particularly if guidance for these really well-owned stocks does disappoint for the next period. Oftentimes, if they do disappoint, the downside for these particular stocks can be very high.
Yeah, it's so important to rebalance their mats. But remember, review the overall quality of your portfolio as well, using our portfolio manager, for instance, and reporting season. That can also expose weaknesses in those highly leveraged businesses, those ones that are financially unhealthy. So we continue to favor those companies with very strong cash generation, reasonable amount of balance sheet risk as well. But that brings us to the end of this week's episode of Taking Stock, and hope you enjoyed it. But thanks, Matt, for your insights.
My pleasure, Kien, and thanks everyone for joining us today. And if you do have any family or friends who you may think will benefit from Stock Doctor, please feel free to send them out our link.
Yeah, definitely. We value and appreciate your ongoing support. Until next time, have a happy, healthy, and prosperous week ahead.